You've been told that the secret to massive business growth is simple: more customers and more revenue. But what if I told you that for 99% of entrepreneurs, that's a trap? A trap that leads directly to chaos, complexity, and total burnout. Maybe you were already feeling that. Turns out that the real key to unlocking explosive, sustainable growth isn't about adding more, working harder, or spending more on ads. It's a tiny, almost invisible adjustment you've never ever likely considered. And in this video, I'm going to show you exactly what it is and how to find it in your business. If you didn't come here from Chapter 7 of the Profit Blueprint book, grab your free copy below in the description. Let's be honest, as an entrepreneur, your default setting is more. I get it. I do the same. More customers, more traffic, more revenue. It's the scorecard we've all been taught to use. So you hustle. You pour money into Facebook ads, you hire more salespeople, you grind it out for 70 weeks, 70 hours a week, chasing that top line number. And for a while, it might feel like it's working. Then the revenue graph is going up and up to the right, but you feel like you're on a hamster wheel. You're working harder than ever, but your actual take-home pay isn't changing. The business gets more and more complex, more customers, more support, more people, more staff, more management headaches. And you're probably stuck in the middle putting out fires. You're drowning in the very growth you were chasing. This is the acquisition trap. You're so focused on fuel into the top of the buckets that you don't realize that the whole thing is riddled with holes. There's a constant pressure to acquire new customers, to just stay afloat. And it's exhausting. It's a recipe for burnout and, ironically, for business failure. You're pulling a lever, all right. You're pulling it with all your might, but it's the wrong one. It's like trying to fix a leaky roof by waterproofing the basement. It's motion, but it's not progress. Here's the mind flip you need. Stop treating all growth as equal. They are not. Your business isn't just some big messy blob. It's a machine with a system of levers, 16 fundamental levers to be precise. The secret to sane, profitable growth is to just stop pulling all of them randomly and instead focus on the one that gives you the biggest result for the least effort. We call this the ELF business. You might have heard that from Joe Polish. Easy, lucrative, and fun. Everything in your business boils down to just 3 drivers. Think of them as the master control for your entire operations: revenue, profit, and cash flow. First, you have the revenue bucket. This is your top line growth. It holds 5 key levers. Most owners only obsess over one, and they may not even track it: number of leads. But there are others, though: the conversion rate, the customer retention rate. How often do people buy? What's your average order value? Getting more traffic is always the most expensive and difficult way to increase volume. We're conditioned to chase what's new. But the real gold is in the customers we already have and our pricing power. Next, the profit bucket. This is about keeping more of the money you make. It has 5 levers: the revenue, cost of goods sold, which is your gross profit, and then payroll, marketing, and overhead. Growth for the sake of growth is pointless if it isn't profitable. Your revenue doubles, but your costs go up by more. You haven't grown, you've just created more stress and a bigger money-losing machine. Finally, and most critically, is the cash flow bucket. This is the lifeblood of survival. It has 6 levers: the days sales outstanding, AR, days payable, AP, days of inventory, buying or selling of assets, loan borrowing and repayments, and of course, you. How much money are you putting in or taking out of the business? Let's face it, businesses don't fail because they're unprofitable. They fail because they run out of cash. You can have millions in sales on paper, but if you don't have cash in the bank to make payroll, you're done. 16 levers in total, your entire business right there. The question is, which one holds your jackpot? So, how do you find the single most powerful lever? You stop guessing and you start calculating. You build a simple model to test how sensitive your business is to each of these levers. You don't need a spreadsheet wizard to do this. The concept is pretty simple. First, we understand where we're at. We plug in our current numbers for each lever, and then we start to play around to see which levers, when we pull them, provide the best results. Remember this, they are all tied together. So when you pull one, others may change, and you have to see how they all move together. Let's work through an example and see what it looks like. Let's walk through something that looks like one of the typical clients that I see and see what levers matter for this particular business. So in this case, this client has 320 leads per year. They convert about 35% of them, which means they get 112 new clients every year. This is not a recurring business. So think of something like roofing or maybe HVAC or another type of business where people buy from you once and you're always finding new leads. So in this particular case, those 112 people, they buy once. It is a large project, $45,000. That gives them $5 million in revenue. Respectable business. Here's what I want you to remember. The zeros are irrelevant. Your business could be $5,000, or you could do this for one product that was $5,000 or product line, or you could add zeros to this. Whether it's 500,000, 5 million, or 50 million is irrelevant. In this case, their cost of sales for this particular project is 52%. Reasonably healthy number. That gives them $2.4 million in gross profit. Their payroll is $1.2 million. Marketing expenses to capture those leads was $302,000. Overheads $500,000. So total expenses are $2 million. Their net profit is $416,000. It's roughly 8.3%. Not bad, not great, but not bad. Now let's see what happens to their cash flow. Out of that, they have accounts receivable. They haven't been paid. $400,000 sitting with their clients, almost a month of their revenue. They've got inventory, and they're holding on to it, almost a month of inventory, $200,000. They owe some of their bills, but they pay them relatively quickly, and so they only owe about 10 days, so that money comes back to them. The owner takes $50K in cash out. That leaves them minus $169,000 in cash flow. So even though they've got a $5 million business with a $400,000 plus net profit, they don't have cash. That's the problem. And they've got a tax bill of $83,000. Surprise, now you got to pay that. Let's walk through and see the wrong way to fix this company. So they did what everyone said. They went and got more leads. They doubled their leads at 640. How'd they do that? They spent a lot more money on marketing. So they doubled their marketing spend, got double their leads. Their conversion rate went down. Why? Because with that much increase in lead flow and not a perfect system and everybody running around a little, their conversions went down. Plus, their leads may not have been as good. They ended up with 205 clients. In order to close those leads, they decided to discount 10%. So their average transaction went down to 40,500. Not bad, 8.3 million practically in revenue. Solid number. Cost of sales went up to 56%. Two reasons. Number one, with all that money coming through and no extra cash, they stopped taking any early pay discounts. In addition, hey, when you ramp up like that, mistakes happen. And so they had to do some rework, and that went into cost of sales. People weren't as efficient because you weren't able to manage them as well. Of course, payroll went up way a lot to cover all of the extra people to be able to deliver that. We know about marketing. And of course, overhead went up, not doubled, but it did go up to cover that. At the end of the day, they made less money, almost 100,000 less. What happened to their cash flow? They grew to 8.3 million and their cash went in the tank. Part of it is they didn't collect all their money as fast as they should have. On top of that, the owner took out the money, and that's where they got stuck. Of course, they have more days of it, more cost in inventory because they've got more stuff coming through inventory. All of that stuff ate up their cash. How do we do this the right way? How do we follow that ELF principle of easy, lucrative, and fun? Let's take a look. Instead of getting more leads, what they did was they increased their conversion rate. They worked on their marketing and sales, and they got it up to 40%. Now, what they did was they spent money. So they spent $50,000 increased in their overhead to be able to do that. I know that says 600. I'll explain it. Their total sales went up to 128. And so their volume did go up a little, which is why their overhead went up. They spent a little bit more on overhead to cover those additional customers. Instead of lowering their price, they raised their price. And by raising their price, they got $49,000 in average sale. So their revenue went to 6.2 million, 6.3 million. Respectable, not a ton of additional revenue though. They also made sure they took their prepaid discounts and they increased efficiency in the field. What did that do? It got their cost of sales down by 2%. Not a lot, a little bit. Payroll had to go up because they did do more jobs, and so they had to pay for some more people. Marketing stayed the same because nothing changed. And their net profit doubled. This is what we're talking about. Work less, make more. The other thing that happened was they got smart with their inventory. They got their inventory down a little bit, and they also collected their money a little bit faster. They got their days of sales outstanding faster. They got prepayments as they could on their orders. All of that resulted in $643,000 in the bank. That is a massive, massive switch. They knew which levers to pull. That's what's most important. Know where to go, what to do, and how to do it. Business becomes easy. For years, you've been playing the game on hard mode, trying to brute force your way to growth. You've been pulling every lever you can reach, hoping one of them pays off. It's kind of like a drunk monkey at a slot machine. It doesn't work. The way off the hamster wheel is not more hustle. It's discernment. It's the wisdom to stop doing 10 things that produce a tiny result and find the one thing that produces an exponential one. Your business is a system. Understand the system, identify the levers, and apply focused effort on the one lever that matters most. This is how we unlock massive, sustainable, and sane growth. It's how you win. You want my help finding the lever? Book a call. We'll identify the constraints and help you get started with the system, along with so much more. Grab a time on my calendar. Let's chat. Or you can just go pull some more levers. Hope it works.